Hello and welcome to Pro Trader Strategies market commentary for Thursday, March the 14th. My name is Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, though, we are here to teach you some different strategies you can then implement into your portfolios, but please do that in your own way. Also remember, past performance of any trading system or methodology is not necessarily indicative of future results. All right, having that out of the way, let's get it on with some economic data. Yesterday we got this daily market commentary going a little bit earlier, and I think I forgot to mention crude oil inventories was a drawdown of 3.9 million barrels, expected to be a build of 2.7 million barrels. Now, if you remember, the month before we were expecting a drawdown of 3.9 million barrels or something very close to that, and got a build of 7.1 million barrels. So that is a huge amount of supply, kind of giving us the thought process that there isn't much demand. So today, or this week, we see this massive drawdown of 3.9 million barrels, expected to be a build of 2.7 million barrels, making it look like we have a lot of demand right now all of a sudden. So these numbers have been really coming in all over the place, and EIA is the government's mandated survey, and you would expect it to be a lot closer. It's kind of like the other one, the ADP number that comes out. So, or the API number, sorry. Anyway, so that number's been all over the place, but let's talk about this week's or today's economic data. We got in the United States, importer prices coming in at 0.6%, expected to be 0.3%. They revised last month's number from a negative 0.5% to a positive 0.1%. So a nice big move higher there is good. Expected that prices are going higher because of inflation, and that is due to demand. All of those levers and pulleys are results of a strong economy. I don't like to see inflation necessarily even in a strong economy, but some economists like to see that. All right, unemployment claims came in line with expectations at 229,000. New home sales came in slightly lower than expected at 607,000, expected to be 622,000. Last month's number was revised up by about 30,000 as well. So that revision on last month's number makes this headline number look a little bit better. And then we got natural gas storages coming in at a drawdown of 204 billion cubic feet, expected to be a drawdown of 211 billion cubic feet. And that's pretty much it for the economic data here in the United States. Sorry, we're doing a little bit of a format differently. I don't know if you can hear my other computer in the background running like crazy. My video cards are finally, I think, dying, so I have those on order. We'll be up and running with those next week, though. All right, anyway, without further ado, let's get on with the overall markets. We can see crude oil is moving higher. We saw that drawdown yesterday that came out after our daily market commentary. So that big drawdown giving a little bit of upward momentum to this crude oil number. So we would expect crude oil to start driving higher. Those 60s might very well be in the realm of possibility. Next week is what it's looking like, especially if we start moving a little bit higher here and settle above these Fibonacci lines here. So we get back up into that area. It's going to look like it wants to migrate up and towards the 70s almost anyway, because once we get peeled through these low volume nodes, has a tendency to want to jump. So we could also see this 200-day moving average acting as resistance, and sometimes what we'll see is a big build out of this bell curve as well. So most of the time we'll see it like peel right through there, but with all of these all this overhead resistance, we could see some volume building up in this little low volume node area. And then on to gold futures. Gold futures coming off after yesterday's big rally. A lot of people were touting that there is a bull story hidden in this gold futures. I don't really see it. I think the economy is doing rather well, and that a flight to gold is not really what I think we're going to be seeing anytime soon. I don't think we're going to see the equities really fall out a bit. I think the economic data has been coming in pretty decent, which doesn't give a whole lot of buoyancy to gold futures. So I'm expecting gold to come off a little bit as it is. I've been talking about that for weeks. And bonds really having no place to go other than their point of control, which is where they're starting to come back to. Yes, they've been moving all over the place. People have been touting, oh, we're going to ease, we're going to tighten, and it's going back and forth. But at the end of the day, we're not going to go anywhere. We're right here back to the point of control, down a half a point on the day with the bonds. And we've got the Dow Jones Industrial Average. Sorry, I don't have the VIX here, but the VIX is looking like it's coming off a little bit. Let me just double check. I don't have the VIX up here right now. So VIX is coming off, but we are seeing the equities rally. We got the Dow Jones up about 36 points. Looks like Boeing has finally come up with a resolve. All of their 737 Maxes are grounded over in Europe. It's going to be a couple of months before they have a software patch for that, so they're working on that. I think it's going to actually probably, if you want a long-term asset, Boeing's probably a good buy at this point, I think. Buy the news. All right, sell the rumor, buy the news. Now we have the news. It's time to buy that. All right, so we've got NASDAQ. It's actually slightly in negative territory since we started this daily market commentary, but for the most part, everything is pretty much unchanged here, or at least slightly positive. We've got the E-mini S&Ps just upticking into positive territory as I speak, but unchanged for the most part here. It's getting a little overdone to the upside once we get outside of the value areas. We're not quite right there, but it is looking to try and pressure that. All right, let's talk about a couple of trades that I've done with JP Morgan. If you guys remember, I was talking about a couple of these trades that I was working as working orders yesterday, and I got filled on them. So this one was one I just pulled the ripcord on it. It's a loser. It wasn't working very well. If you guys remember, I had on the April 105 straddle, and it was a long 105 straddle. I paid $7.62 for this strategy, and finally pulled the ripcord yesterday. Today's little pop would probably come in, at least a movement would have made it look a little bit better. But look, again, it's right back to the 105 strike, which is, where my strikes are. So that isn't going to help me. I'd probably even be losing money again today. So I dumped out of that trade, sold it for $7.62, bought it back for $4.50. So it is a losing trade. And then, sorry about that. Let me pull back up Amgen real quick and see what we got here. Or let me pull that back up that because I covered Amgen also. And Amgen, I talked about having a working order in there throughout the day as well, and finally got hit literally almost half an hour after we got done with the daily market commentary. And if you guys remember with this, I was playing it as well with the straddle was a long straddle. This one I was able to take advantage of some of the higher implied volatility that we had back here on like the 7th. I think I talked about it. Where is the 7th? Right here, the day before the bottom came in there. So on the 7th is where I put this trade on. We had pretty good high implied volatility. The volatility came out. We also got the theta decay. I got the directionality correct to the upside because I had on the April was short the 165 puts I talked about yesterday, and I collected $1.98. Those 165 puts was beautiful because with the collection and the strike, I was able to get below the 52-week low here, which it was perfect. If it broke the 52-week low, it was an easy out, and I was expecting it to get it was getting a little overdone, getting outside the value area, and I expected the rally to happen back to the point of control, which is exactly where we got, and able to get out of that for 50% of max profit. Obviously, today it would have been maybe a little bit better. You probably could have gotten out for maybe 50 cents or slightly better, but I'm looking for my profit targets, and that's what I did, staying mechanical. I always talk about this: plan your trade and trade your plan, and I traded my plan. All right, so I sold those 165 puts for $1.98, and I got out for 98 cents yesterday on that little pop. Again, it got better throughout the day, but my profit target is my profit target, and that's what I'm going with. All right, so today we're going to be doing a webinar on the short Iron Condor, great for high implied volatility strategies. I'm going to show you how to set this strategy up to increase your probabilities of success. You can go online and figure it out, but they're not going to tell you how much collection you need in order to do this trade. They're not going to tell you where volatility needs to be or how many days to expiration we should be setting this up in. I go through this, all the rules. You go through step by step and find out if it's appropriate for your assumption and your underlying. Okay, so check it out at protraderstrategies.com. That's all I got for you guys, and I'll see you this afternoon. All right, take care. If you can't take that,